Hi guys, Max here, and this is your daily market update for yesterday, Monday, the first day of the week. Now, it was a little bit of an odd Monday because US markets weren't open, which is why we're looking at a world map of stocks right here because, well, US markets didn't open as I said. Now, there were, of course, futures actions and various contracts and derivatives, so we do have a rough idea of how American equities performed, even if it isn't perfect. Futures on the S&P 500, for instance, rose by about 1.1% across the course of the day, and futures for the Dow Jones rose by about 0.9%. In the rest of the world, it was really quite a mixed bag. As you can see, the Americas weren't too clean, but the rest of the world was all right. Asia was quite strong, and Europe was cautiously okay. The FTSE 100 rose by 1.7%, and the Stoxx 600 rose by 1% for the day. On the whole then, the MSCI World Index rose by about 0.2%. Now, what was really going on to drive this movement in equities? Well, it was just a very slight and uneasy rebound from what was an absolutely awful week before, where equities fell 4 or 5% on average. Now, yes, stocks were slightly up, but volatility was still extremely elevated, so we shouldn't expect this crazy movement, these big ups and downs, to stop anytime soon. And frankly, the macro conditions which are driving this market are exactly the same today, and they were exactly the same yesterday as they were the week before, so we shouldn't expect anything magnificent coming out from markets over the next few days. Now, the dollar fell very slightly against an index of its peers, down by 0.2%. The euro rose very slightly, as did the pound. They're now sitting at about $1.05 for the euro and about $1.23 for the pound. And then the yen was pretty much exactly where we left it the week before, sitting at 135 yen per dollar. In the rest of the world, though, bond yields advanced. They rose by quite a decent amount. The German 10-year yield, it rose by 9 basis points and is now sitting at 1.75%, a far cooler from where it used to be when it was practically always negative. The British 10-year yield rose by 11 basis points and is now sitting at its highest point in not just 2 or 3 years, but about 8 years at 2.6%, which is really quite intriguing. Now, in the world of commodities, oil prices are a fair bit lower today than they were at the worst points of last week, with WTI crude oil being at about $110 a barrel at yesterday's close, and Brent crude being at about $113. Frankly, though, this price action here is purely down to speculation regarding a few different things. Firstly, there's this idea of an oil price cap going around in the US and in Europe in particular that we'll discuss in a moment. And then there's a lot of speculation regarding the potential for reduced oil demand in the future due to the huge amounts of recessions which are being predicted in every country, and the idea that China might be slowing down as well. Finally then, for traditional markets, what happened to gold? Well, it's sitting pretty at about $1,840 an ounce, so no major moves there either. Now, in crypto, what's happening over there? Well, it's some very slight bullishness after an absolutely awful week. As you can see from this table here, Bitcoin and Ethereum both up a little bit for the day by 4-ish% each. Bitcoin is above $21,000 and Ethereum above $1,100. Obviously, a far cry from where they were sitting just a couple of weeks ago and a few months ago. That's even worse. But it does seem like the crypto market route for now has at least stopped to completely collapse. There is still a lot of fear around everywhere, around 3AC, around Binance and companies like Celsius that really hasn't been resolved at all. Those problems are still 100% present. There's also a brand new problem that's suddenly capturing everyone's hearts and putting a lot of fear out in the market, and that's surrounding Solana. I made a video covering it yesterday, but in short, it's an incredibly centralized protocol where the other day they announced they were just going to take control of $270 million of someone's assets. Yep, they were just going to take it off them, and suddenly you have no rights to your assets if they're on the Solana network anymore. They did, in the end, back out of their plan and change their mind, but it doesn't really matter. True colors have been shown, the authority that they have has been shown, and Solana has basically been exposed to be a worse version of a bank because it doesn't even follow standard regulations. It doesn't even have to abide by US law because it isn't a real bank, and because the coins that you use in that network aren't even real money either. So it's an absolutely terrifying prospect, and that may not be damaging the crypto market right as we speak, but it will do at some point in the future, so be careful with that. We also did get a little bit of news coming out of Binance, where they announced that they had bought $2 billion worth of Bitcoin to try and stabilize the price, which a lot of people have been celebrating, but frankly, I think that's a little bit ridiculous. It sort of seems reminiscent of a company like S&P going out and just buying up assets to try and stabilize prices during a market crash or a rout or a recession. It isn't supposed to happen in healthy markets. Companies like Binance should not be trying to regulate the crypto markets. They should allow buying pressure and selling pressure to determine an accurate fair market value of this token, but they don't really want to do that. Of course, they're trying to stop this entire market from collapsing and from a lot of companies going under, so they're resorting to just deploying huge amounts of capital. Now, there is quite a lot of drama going around specifically right now about housing markets in a couple of different countries, in particular in the US, in Canada, in the UK, and the Anglosphere in general. Maybe that's because they're the worst bubbles, or maybe it's just because we speak English in those countries. Who really knows? Either way, things aren't looking great because as interest rates rise, mortgage rates have been rising too, and actually at a far greater rate, and this is very worrying for a number of reasons. Basically, people spend as much money as they can on their house. They push their budget as far as they can, and it tends to be the greatest singular expense in almost every household in the world, your mortgage or saving for a deposit and things like that. And so when interest rates rise and mortgages get more expensive and those monthly payments increase, well, there tends not to be an awful lot of wiggle room unless wages rise with those interest rates, which of course we know they haven't been. As a result, the chances of housing prices actually falling over the next year have massively inflated recently, and to the point where we're actually reading about this on mainstream financial news outlets like Bloomberg here. As you can see, US house prices are likely to drop as rates rise, coming from Capital Economics. Now, the article really isn't anything special. It doesn't just say anything groundbreaking. It does predict a 5% decrease in the average house price by the middle of next year, so in exactly 1 year's time, which is a little bit drastic and would be worrying to a lot of people. But it's not at all an unreasonable thing to expect. Mortgage rates right now are nearing in on 7% average. Average about a year ago was 3%. So monthly mortgage payments are on the verge of literally doubling over the course of a year. That just isn't sustainable. Now, Capital Economics, this specific group which is making this prediction, do then clarify that the year after 2023, they are then bullish on housing prices. Frankly, I'm not so sure if I am. It just really depends on the Federal Reserve's actions, on whether or not we see inflation come down and how drastic this recession that we're about to enter is as well. Frankly, this isn't something that you can actually make an accurate prediction on over the next 3 or 4 years with the data we have today. Now, there's also a massive problem with this in the UK. As I said, we're also seeing interest rates rise and mortgage rates rise with them. So we have that same sort of problem. We also have a housing bubble. Affordability crisis is the words that we tend to use. In reality, we don't build enough homes, but who wants to hear about sensible solutions to real problems? Our government certainly doesn't. They have resorted to instead get rid of mortgage affordability rules to make it easier to get mortgages that are costing more money. And so when a recession comes and people start losing their jobs, there's a greater chance of having another 2006, 2007-esque housing market crash. Now, you might be able to tell from my tone there, but I'm not particularly excited about this idea. I don't think it's a smart thing at all. But there is a chance that it doesn't really have any impact because they're still keeping in other caps on how much of a mortgage you can take out. So this might be some kind of a vote buying idea to try and convince first-time buyers, people who don't have homes, that they're trying to help you buy a home. Now, I'm actually going to speak a little bit more about this, about the housing market in general later today, because it's obviously a massively nuanced topic and there's just loads to cover and there's a bunch of other markets to cover as well. And the big problem with the housing market is that it is totally enshrined in politics as well, because people who own houses tend to vote right-leaning in the long term. So right-leaning parties tend to incentivize people buying houses and they try to maximize home ownership, especially here in the UK. So you have all sorts of irresponsible and short-sighted government policy dedicated not to actually helping the public, but to keeping a certain party in power. Now, we mentioned oil prices very briefly earlier today because they have fallen over the last week, which is nice to see, not by a ridiculous amount, and they're still historically incredibly high, so it's not exactly good news. But the US and US allies like the UK and Europe and other countries, well, they're trying to put into place plans to hopefully fix this oil price crisis. Now, what do we actually know about these plans? Well, not much at all, except for the fact that they're talking about an oil price cap, just literally saying, here's the limit on how much you can charge for a barrel of oil. And then the idea is that will then reduce prices in the future. Now, the US and the UK and a few other countries have already been releasing oil in the form of strategic oil reserves. a million barrels a day coming out of the US, and actually I think a little bit more now. About 250 million barrels of oil has been pledged over the course of this year to be released, all obviously in an attempt to increase the supply and reduce prices. So far, it hasn't had any noticeable difference on oil prices. I mean, maybe prices would be sitting at $140 a barrel if that hadn't happened, but we are where we are, and oil prices are still too damn high. Now, the problem with this is obviously that price caps often don't work. They often just exacerbate a supply problem in the first place. It's not entirely clear if that is what will happen here. Basically because the oil market isn't a free market because of the OPEC cartel and because of government intervention and things. Yes, usually you would expect a price cap to basically just to reduce the amount of firms that are willing to produce oil and sell it, because it would reduce their profits and it would make some of them unprofitable altogether. Here though, it might not work that way. We might see OPEC in the end just decide to increase the supply of oil because they might be able to maintain price levels at that price cap, so they're still selling them for the same price while increasing their volume, thus increasing their revenue and profit. That will be what Yellen and other people discussing this sort of plan will be aiming for. Whether or not they'll reach it, well, who damn knows. A big problem with this is that they're still trying to maximize sanctions against Russia, which is of course the main reason for this oil price spike in the first place. This time they seem to be focusing on insurance regarding shipping oil around the world, because 95% of the insurance for that industry in the entire world, from every country, Russia, China, India, the US, you name it, 95% of that business comes from London. So the idea here is that they would ban those businesses from operating with oil that comes from Russia, thus making it impossible to insure oil being exported out of Russia, and hopefully that would then make it harder for Russia to export their oil. Would this actually work? Personally, I sort of doubt it. I don't see why another nation, another industry, another business, other insurance companies wouldn't just fill that gap that's left by London. I think this would just destroy that industry in London, and it probably wouldn't have any lasting effect or impact on Russia's ability to export their oil. Now, inflation being the big ticket issue here again, we're hearing some more about the Biden administration considering removing the tariffs that they have on Chinese products. Now, this has been discussed for a couple of months now. These were Trump-era tariffs that were put into place to try and stop so much being imported from China into the US, to try and help the US's balance of trade and to reorient the supply chains of the world away from China a little bit. Did it work? Not really, it seems like, but nonetheless they were kept in place by Biden and have been kept in place up until this point. Now, the idea going around here is that these tariffs should be relaxed or just gotten rid of altogether, because they just make it a little bit more expensive to import things from China. And as of right now, we are still importing massive things from China. Now, would this help inflation in the short term? Yes, it almost definitely would. I don't really see how it wouldn't. This article here, which is quoting a US ambassador who's saying it should happen, well, they say that it could help reduce inflation by 100 basis points, 1% over a few months, and that it could help Biden in the midterms. Frankly, I don't care about it helping Biden in the midterms, but if it reduces inflation, then frankly, that's not a bad thing in the short term at least. The problem with this policy is that in the long term, we need to do the opposite as Western society and shift production outside of China to other countries which aren't quite as hostile to Western ideas. This would make that more difficult, and it's quite unlikely that if Biden does remove these tariffs that they'll be put back into place by a Biden administration if he's re-elected, or if another Democrat is back in power in 2024 as well. Finally then, we got some news coming out of Bridgewater, which is the largest hedge fund in the world and run and founded by none other than Ray Dalio, of course. He's incredibly infamous. And some news came out that he's opened up $10 billion worth of short positions against pretty much every major European company right now. Now, when I say every major European company, I really do mean it. We have Louis Vuitton, Moet and Hennessy. We have Sanofi, a massive healthcare brand. We have Siemens Gamesa and Alliance, L'Oreal, and another 50 different major companies. Mercedes there, Airbus, absolutely massive European companies. Basically, Ray Dalio is betting on a massive Europe-wide recession and crisis, and it's sort of hard to argue against him here. Now, firstly, he hasn't done this in a public manner, or at least yet. He hasn't done a Bill Ackman and gone on CNBC and told everyone that hell is coming to Europe and to sell all your stocks. He's just done this in private, but of course people can track and see what Bridgewater is trading, and so we know what's happening behind the scenes. Again, it's hard to argue against him here. Europe is in so much trouble right now. They're on the verge of another debt crisis with the pig countries seeing their sovereign debt yields rise beyond levels that they can afford to repay them. The euro itself is in crisis, the shared currency, because it's trying to service a myriad of different countries which all have different needs right now. As I said, the pigs need yields to fall, whereas countries like Germany need inflation to fall, and those two ideas don't really go hand in hand. The entire continent is facing a recession. Countries like France have already started seeing negative GDP growth. And then, of course, they have the energy crisis stemming from the Russian invasion of Ukraine and then Europe's reaction to that. There doesn't really seem to be a way out here. I can't blame Bridgewater or Ray Dalio for taking out these positions. It just kind of makes perfect sense. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.